Okay, let's get started. This time I remembered to click record on our podcast, so we'll have that again. Yeah, good. Okay, that's recording. So, in my ongoing memorization efforts, close to complete. Nalita, you're sitting early where Amanda would. Amanda's not here, right? Okay. And Marissa, Kitty, Alexis, Fuji, Dahi would be there, and Ton. Was Dahi here already or not? No. Okay. And then Anna, Maria, Maddie, and we're missing Esperanza. I saw. Okay, Esperanza's here. Cool. And then Marlise, Richard, Marlise, Nancy, Jeanette, Myra, Katie, Sam, Selena, no, nothing. Jacqueline, Jessica, Rachel, Nancy, Maria, Amanda, excuse me, is that Andrea? Amanda's over there. Andrea, Yanira, Jeff, and then Zach, Jacqueline,
I don't know.
Hyder,
She was asking about my questions.
Haley, and are we missing Nathan?
Questions in my narrative.
And then Anthony, no, Daniel,
I mean, my narrative.
and Vanessa, and Mariah, right? Okay. And then Lily, Gabrielle, Lovetron, and we're missing Bagat and Ernesto, right? Okay. Okay, so let me turn on the screen here. Coming up. There we go. Okay, so here's our agenda for today. Yes, Haley. Huh?
On the quizzes, you can take them as many times as you want, or are you only supposed to take them once, or what?
No, it should be only once.
I took some, and then I went back, and then it didn't give me like my score or anything. It said like, oh, you have 40 minutes to retake this. So that's why I was wondering, like, it's acting like you have unlimited time.
It should be limited. Thank you for telling me.
I just want to be able to see my score.
Do you know which quiz that was on, Haley?
I think 1 and 2.
Mine showed me my score, but it wouldn't let me retake it.
Yeah, when I click on it, it says like you have 40 minutes to attempt this again.
It should be single attempts, but let me check and make sure. That gets me to announcements, actually. The first of which is a reminder to everybody that the chapter quizzes are due by the end of this coming weekend. So if you haven't done them yet, you need to go into Blackboard before the end of the weekend. Go to the what's that? Yeah. I just take your top 3 scores, so if you take 3 of them and you like those scores, you don't have to take the rest of them. So you just go to the assignments section, and then go in. Let me check here. Edit the test options, just in case this has the answers on it. No, it should be single attempt. I'll email the Blackboard people to check, but it should be just one attempt. And if you're not seeing your scores, I'll ask them why you're not seeing them. Okay? Okay, let me close that. Turn the screen back on.
Sorry to interrupt.
That's okay.
It's like deja vu, right? I'm taking the test this class, remember? The exam, everybody shows
No
up.
problem, man.
Okay.
Good to see you, Vince.
I'll probably come one more time.
Okay. I had the same problem last time. Like if I switch it off and switch it back on, it takes it forever to like power up again. Yes, Lily. Folks, everybody who's not Lily, quiet so I can hear what she's saying. No, unfortunately, I forgot to click record. So there's no podcast for last Wednesday. Sorry about that. Although I don't have a deadline on this, but it occurred to me as I was going through and organizing how to make the class more efficient. I could actually record all of the I could record podcasts of all my lectures, like over winter break, for example, and every future version of this class, like I could just stop lecturing and have you guys just go play the lecture, and then we could spend the whole time just interacting, and I could answer questions and stuff. Like it occurred to me, I could go in and do. Basically, I was giving examples in that one of how to do the financial, the market sizing, and I could just record that once and use it for all my classes in the future. So, if I get the time, Lily, I will try to record a podcast just for its own sake, so that if you had any questions or problems with how to do market sizing, that you could look at it. But unfortunately, right now it's not recorded. I need to go in. Folks, please, I'm happy for you to talk amongst yourselves, but do it quietly enough so that I can hear myself. I will try to do that. Okay? I don't know. I don't have a deadline on it, but if I have some extra time, I can just go in my office or at home and record exactly what I want to teach. Okay, so that's that. Okay, so remember, first announcement, everybody needs to go in and take these chapter quizzes before the end of the weekend. If you haven't already, I will look in. If anybody besides Haley is having a hard time seeing your scores, let me know, and I'll ask the Blackboard support people what the problem is. And then, like Zach, I think, asked, I'm only going to take your top 3 scores. So if you take chapters 1, 2, and 3, or 1, 9, and 10, and you like those scores, you don't need to bother taking the rest unless you want to improve your scores. Okay? Make sense? Okay. That was the first announcement. Second announcement, I'm making progress on your LinkedIn and professional development plan markups. I'm not going to say how much progress, but I'm making progress. And as soon as they're done, I will get them all to you, okay? And then finally, I wanted to give you a little bit of an update on guest speakers.
I've confirmed who's going to be talking to us for accounting, and it's Danira Milan, who's the audit director at Barbara Trooper King. So she'll be here on November the 2nd to talk to the class, and I'm still pinning down the rest of the dates, but I wanted to give you an update on that. Later today, tomorrow, as soon as I can, I will send an email to everyone with link with the names of the speakers, a link to their website or their LinkedIn page, and then a link that you can click on to write up questions for the speakers. That'll be the rest of your that's part of your participation grade that you don't have yet. So I will send that out later this week. I think I'm going to make all of the questions, even though the speakers are speaking at various times over the next month, I'm just going to have you write up all the questions by the end of the week so that they're ready whenever the speakers get back to me and tell me that they're available. That way I've got them all ready for the speakers, and I can go ahead and give you guys your grades, and we can move on with that part of the grading. Sound good? I'm just going to put together a spreadsheet with everybody's names. Go in, type your question for the speaker, so there'll be like a different spreadsheet for each speaker, and you'll just go in and in the row next to your name there'll be a column for your question. Just type your question into that cell in the spreadsheet. If you want to do multiple questions for the speaker, just put a question mark and a space and like type the next question after the first one in the same cell. Okay. So that's that. I'll send that email as soon as I can. The rest of the agenda for today, quick review of your feedback for me. Thank you for those of you who gave me some continuous improvement feedback. I'll go over Globus. This is the first time in the history of me running Globus in this class that like 10 out of the 11 teams are at or above investor expectations. There's only one team, Focus, that's below, and like you're at 80-something%. I mean, this is phenomenal performance. So I'll go in and talk a little bit about Focus. Is that you guys? Okay. I'll talk a little bit about your decision entries and what I would suggest you do, and everybody else, you're doing well. I mean, I'm actually going to just focus on the team that's not at 100% of investor expectations, and anybody that has questions for me because you're just overachievers and you want to like beat your your classmates, feel free to come up to me after class or my office hours or send me an email and I can help you more with your decisions. But everybody's doing great, and you guys are actually doing great as well compared to a lot of other classes. But I want everybody to be above 100%, so I will work on that in a second. And then we'll go through the lecture on financial analysis tools and we'll be done. Sound good? Any questions? Okay. Just another quick announcement. I sent out 2 emails last night. One to everybody with my markups on your draft number 2. I also sent out a shorter email with markups for people who I had not done markups for your draft 1 yet. There's a couple people that are missing one or the other tool for draft 1 yet, and Ernesto, I still need your like draft 1 and draft 2. Okay? Like as soon as you can. Other than that, I should be up to date on giving everybody your feedback. There's about 7 that I was missing for draft 2 that I put your names in the email last night to let you know that I'm missing your stuff. And I have not yet downloaded the draft 3s, so I will start working on those tomorrow and let you guys know what I'm missing at that point. And then this weekend you'll do financial analysis. It's actually just 1 tool this time, so should be a little bit less time for you and time for me to grade it. And then next week we'll talk about the summary, and you'll do that one the following weekend, and we'll be done with your drafts. And pretty much that's, as long as you make the edits that I told you, that's all you have to do for your final paper too. That's the whole point of having the drafts up front, is that by the time we get done with the class, you've got a nice professional looking product that you can post on your LinkedIn page and show to potential employers in the future. So we are making good progress in that regard. Just wanted to let you guys know. If you haven't gotten something from me and you haven't gotten an email from me saying that I'm missing something, let me know, because I should be up to date at this point, grading everything that I actually had for draft 1 and draft 2. Okay? Cool. So, continuous improvement feedback. Largely pretty good. So, how could I improve my efforts for the subject matter? I'm very helpful, always available, doing great. Thank you. That makes me feel really good. Enthusiasm. It shows that I love my job, which I do. Thank you for whoever said that. It's good to know that that comes across. Intellectual challenge. Keep the current level good. I'm glad that you find that it's practically useful. That was exactly what I intended. I think in general, I've gotten feedback that the number of drafts and everything, like I shouldn't do any more on workload. Like I might actually in the future be able to be more challenging and less sort of like spoon feeding with stuff. But it's good to know that nobody has any complaints here and that I should just keep it at the current level. So that's good. Sounds like the syllabus matches okay. Good. I'm feeling great about myself right now. Thank you, guys. So explanation of the grading system. It seems a little complex, but it's fair, and the syllabus explains it well. Thank you. That's actually the first time that, I haven't had more comments on the grading system. So I think over the course of time, I've done a better job of explaining it in the syllabus. I will consider in future classes if I can make it any simpler. Thank you for that comment. I don't know if I can do anything about that right now, but it is a little complex, and if I can find ways over winter break to make it more simple, I will consider that for future classes. If there's anything that occurs to me, I'll make it more simple going forward for this class too, but it kind of is what it is right now. But thank you for that suggestion. Grading and responses. Responding great, putting grades out on time, thank you. Evidently no one was actually commenting about my grading of your LinkedIn profiles and professional development plans when they made that comment, because I'm feeling guilty that I don't have that done yet, but honestly, is there any other professor you have that asked you for that stuff? So this is all just to set expectations properly, this is all icing on the cake. I think it's really important. I think it's actually in some ways more important than anything I teach you in this class, making sure that you're on track to reach your professional goals in life. But that's all sort of icing on the cake, and it takes me a while to do. So I'm glad that you think I'm doing good, at least with the homework grading, and I promise you I'm making progress on your profiles and your professional development plans. Availability for office hours. I make myself available. That's good to know. Thank you. Maybe clarify a bit more with the case analysis. Actually, I'm going to, in order to do something, because most of these comments are, thank you, they're compliments. There's not a lot of things to improve. Based on what I was telling Lily before, I think one of the ways that I could be clearer about the case analysis is actually to have these podcasts prepared beforehand. So, of the stuff that I've made comments on so far, including the stuff that I'm about to do this week that you guys have done already but I haven't commented on yet, if I were going to do a podcast clarifying again exactly what I want you to do for tool X, Y, or Z, which one would you find most useful? Hands for business model, the very first one. Hands for all the searches that you need to do on ProQuest and stuff like that for managerial execution. Hands for that. Okay. Corporate responsibility measures is kind of the same thing. Everybody seems to be doing pretty well on that, so I don't think that's the main one. You actually all seem to be doing pretty well as well for driving forces and Porter's 5 forces. Market positioning maps, hands for that. Market sizing. Yeah, okay, so it seems like I'm on track to do that one. And then from this week, anybody that needs... that feels like I should do a podcast on value chain benchmarking, or on Lily, okay, or on leveraging international competitiveness. Okay, so I'll start on market sizing and see how far I can get. Eventually, I want to do this for all of them, but like as an attempt to make things clearer, I'll try to do at least one podcast that I just post for everybody to be able to reference, and see if that helps any. Okay. Perfect. How could I be more supportive? I'm supportive already. Thank you. I try. And then reduce the case analysis from 2 companies to 1 company. Okay. I might, like, I can't really do that right now because I've already set it up the way it is. And honestly, a lot of what I want you, like, if you're just analyzing 1 company, some of the competitive aspects that we get to in comparing them are lost, but I could actually do some of the searches more easily. So you kind of search in depth on 1 company and search less on another. I can't think of how to change that right now, but let me tell you, like, something I was thinking about for future classes. Ideally, rather than having you guys do generic case analysis, as it were, for 2 companies that are in the industry that you're interested in, but may or may not be the ones that you're working for, I had an idea in the future that I'd actually like to do. I'd like to chuck the case analysis tool completely, and instead, like, have you do a real project for the company that you're planning on working for after you get done with graduation. So if you're already in, some of you already are sort of like going to stay at the company you're at and move up, and then maybe later in life move to another position. Others of you are looking to get into a new industry after you graduate. Like, it is theoretically possible that, there's always a certain number of people interested in accounting. There's always a certain number of people interested in banking, entertainment, etc. Most of the major areas, petroleum, agriculture, that all of you have mentioned, I could theoretically have companies in mind that have projects that sort of resemble an internship, but it's a project you do for the class rather than a formal internship per se. And I would prefer actually having the companies tell me, what do you want the students to do? And then you're actually doing something that's valuable to them, and it makes it like, so Nalita, if I go to the far end, for example, I'm quite sure I could find somebody between Omnicom and who are you comparing it to? I forget.
IPG.
Yeah, and IPG. I'm sure I can find someone who'd be more than happy to have you do some like legwork on a certain project. So rather than having you do this case analysis, they would just say, okay, Nalita, we're doing an advertising campaign right now for Nestle, and we need to know this kind of research about like customers, and we need to know this kind of research about the like operations of the competitor, because we're going to try and weave into the advertisement some dig about how Nestle is better than their competitor because of this, and have you do that rather than the case analysis. Does that sound like, whoever made this comment / everyone else, does that sound like it would be useful rather than doing a generic case comparing 2 companies? Hands for yes. Hands for no. Okay, cool. If I can do that before the end of the quarter, I'll try, but we're a little bit late on that. But I appreciate that there is value in going more in depth on 1 company, so thank you for that comment. And last of all, what could I do to be one of the best instructors you've ever had? Pretty much it sounds like I'm doing it already. Thank you. And then good to know that you're going to recommend the course. In certain ways, like whether you recommend it or not, everybody has to take it. But you could take it from me rather than taking it from David or Lori. So it's good to know that like you recommend my version of this class. So thank you. If there's anything else that you guys think of that you did not write up already, I'm not necessarily going to go back and check this thing. So it's hard to like do the anonymous thing. But if you think of something else that I could do to improve the class, please feel free to let me know anytime. And I'm always looking for ways that I can make it better. Okay, so thank you for that. That was agenda item number 1. Any questions or further comments about that before I move on? Okay. So, for Globus, okay, this is just like staggeringly good performance. I'm so proud of how everybody's doing so far. Let me dive right in on comments for focus, and then we'll move on to the rest of the lecture. Sound good? Okay. So the first thing I always suggest, like I have before, is going in and seeing where your product stands compared to the rest on the production benchmarks. So you're pretty much like lower than the industry average on all 3 of the entry-level components, and then you're also lower than the industry average on all 3 of the multi-feature components. So first thing I would suggest is making sure that your price matches that. So the average in North America for entry level is 169 and multi-feature is 414. In Latin America, 168 and 410. Europe 165 and 405, and Asia Pacific 164, 406. So you're going to want to be below those numbers in all 4 of the markets, and not just by a little bit. So not by too much, but you want you're not like right in the middle. You're actually on the low end. So you want to make sure that you're not just a couple dollars below the industry average if you can do it. So. But we also want to make sure we don't butt up against the cost. So $97 is what you're producing for right now. Looks pretty good. So we don't want to get close to that. Oh, and $257 for multi-featured. So we'll just keep those in the back of our heads. So quickly, Singapore's got a little tiny bit of deflation. So prices should be slightly lower in Asia this time, but they should be significantly higher in Brazil because Brazil's going to have a lot of inflation this time around. So going back to the production, back to the snapshot again. The next thing I want to do is actually see like how has the price been trending. So if we look Asia Pacific, this is actually the year before the game started. Okay, so before you guys started making decisions, 160 was the average for multi-featured, 370 or for entry level, 370 for multi-featured. We went up in year 6. Prices went up again in year 7. Came down slightly in year 8. Okay? So it's hard to predict. Honestly, everybody else is doing pretty well, so theoretically, you guys are the only ones that are below 100% of investor expectations. So all things being equal, everybody else may keep their prices the same, except for you, who needs to lower them a bit. So theoretically, that would mean that the overall industry average drops a little bit, but not too much. But I'm telling everyone this right now, so maybe the other teams are going to go in and change their prices. So the first thing is, based on how it's gone these first 4 years, 3 years, where do you think the prices are going to go? Are they going to go up? Are they going to go down? Are they going to stay the same? Okay? First thing to think about. So that's Asia. Let's look at the same information for Europe Pacific. So Europe was 163.70. Oh, and then it went up. It went up. It went down. No, it went down for. Yeah, that's right. So it went down for entry level, but it went up for multi-featured. So that's Europe, Latin America. 370 went up to 170.405, so it went up, went down. So that's Latin America, and North America went up, went down for multi-featured, but went up a little bit, or went down for entry level, went up a little bit for multi-featured. So based on all of that, I would say that like prices in entry level are going to go down a little bit, and multi-feature is probably not going to change too much. So that being the case, and now we remember, 169 and 169, 414. This is North America, and then Latin America, 168 and 410. We're going to need these numbers when we put in your marketing numbers. So Europe, Africa, 165, 405, and Asia Pacific, 164, 406. So based on all that and the fact that you guys want to be below the industry average, now let's come back here. North America, the industry average is 169, you're 172. You want to be below. So how about 160 here? Then we'll look. Europe, Africa was 165. You're at 168. So I would suggest something like 162 here. And then Asia Pacific was 164. You're at 166. So I would suggest maybe 161 there, or 162, because we said we want it slightly higher because of the deflation. And then Latin America, 164, you're at 162, but there's significant inflation in Latin America. So let's assume that everybody noticed that and prices are going to go up in Latin America to counteract the inflation. Maybe we'll put you at 165 and just see how that goes. And then we're going to need to do the same change. Oh, before I go forward, we said that we thought entry level prices would go down a little bit, but multi-featured will stay the same. I think everybody's pretty locked in on their price quality ratings, so I don't think those are going to change very much this year. But I do think people are going to make more changes in their promotions, their marketing, stuff like that. So I think that's going to be more competitive, actually. So apply those so we've got the right projections and the same. Actually, we already applied for both. So now we need to move these prices to the right place. So 414 was the industry average. I would shoot for more like $3.99 here. 410 was the industry average in Europe, Africa. Maybe $3.95. Asia Pacific was 406. You're at 385. We want prices to be a little higher there, actually. So maybe 397 here. So you're actually going to raise your price slightly there. And then Latin America, the average was 406, but we also got to take account for inflation. So I'd put yourself right at 400 for this and see how that works. So that, now we've changed all those. Personally, just like you have a relatively low-end camera, so I think you need to spend more on quarterly technical support than you are right now. I'd bring this up to 400 maybe in all 4 of the markets. See how that works. I also think you're low, but you're not the lowest in the game, so I think you may be spending a little too little on advertising as well. I'd move this up to 750 in all 4 markets. And I know your numbers are going down right now, but that's because we haven't changed for the increased demand that you're going to get out of all this. So there's all that. If we go now to entry level, you'll notice there's a lot more demand for your products. So if we max all those out, that's gone up. Multi-featured, a little bit more demand, not as much because we didn't really change your prices as much as we planned. So that's better, but not amazing yet. Let's keep going and see. I think your 4% change is actually going to put you like a little bit too high on compensation. I would move that back down to 2. And that just puts you just a little bit below the industry average. So maybe, I don't know, maybe bump up the perfect attendance slightly. And then we're going to hire 10 more here, 1 more here, 75 more for the holiday production, and then lay off 73. Because you need a few more than, you don't actually need to lay them all off. You still need a couple of those because you're growing. So 48, 49, just max all these out. So moving forward, but not all that far yet. Oh, hang on. So if you notice, I changed your cafeteria here. Like if you change the cafeteria, it actually like makes the workers slightly more happy. So one of the only places where you do need to go backwards after making a change is if you change anything here, you have to go back and see if you still need the same number of workers. So basically, by making that change, you needed to hire 1 less here, which helps just slightly. So there's that. And then for finance and cash flow, let's see. Your credit rating's pretty good right now. Let's see if we have enough cash to buy back as many shares as you can. That brings you down to an A-, but improved your ROE and earnings per share. It probably will improve your stock price as well. So let's leave that the way it is for now. I'd actually move down. You're underperforming the rest of the market, so I'd actually like not be quite as aggressive with your dividends. It's kind of status quo there. Here's like you're better but not best. Here's like the next learning point, and actually this is useful for everybody else too, not just you guys. Like we've changed most of the major factors that are going to help. So there's two things that are going to like make a difference for you guys. Either A, you need to go in and change where you're positioned with your features. So either move more aggressively down or move up slightly, and that you change accordingly with your price. Does that make sense?
That's what we did.
What did you like? Where were you the last time? I can't remember.
Like one space up. You mean in the rankings of everyone?
No. Like, where were you with your price? How much? What was your cost last time? Huh?
You told us our prices were way too high.
So did you move down your production values as well, or just your price?
First we just moved our prices and then it didn't work. And so last time you told us to do the same thing and we did that and it didn't really help.
Well, it kind of did. You went up from. Actually, you're right. You went from 85 to 84, so it's pretty much the same. Let me go to one other thing here before we start tweaking more with the marketing factors, or before we start tweaking with the production factors. Let me look at another thing here. So if we go back to the competitive intelligence report again, like you're basically competing with the other kind of low-priced cameras here. So company D, company H, to a certain extent, like even some of the other companies that have a higher quality camera are similar in price. So the first thing that tells me there, the highest, except for company G, the highest price in the market is $170. So you may actually want to bring prices down a little more now that I look more carefully. Is that the same case? Yeah, it's the same case in Europe. Group A is way high in Latin America, actually. Why? That's crazy. Why is Group A so high? Actually, no one from Group A is here, too. I forgot to write down before in my attendance. Like Macy, Natasha, John. So I don't know why they're so high in Latin America. Probably because of the inflation stuff. And then North America, yeah, like I think you may still actually be too high, even though the average is there where it is. That's really being dragged up by Group G and like J and B a little bit. Otherwise, everybody else is kind of low. So the other thing I was going to suggest is if you look at the other low-priced cameras, like so we got 151 and 160. So if we look at Group H and Group D as examples, like one promotion, 1 week, 10%. One promotion, 1 week, 14%. 1 year on warranty, and then you guys are 115. So you're a little bit deeper on discount, but you're only got a 6-month warranty period, which is costing you sales compared to the other two competitors, basically. You might. So that's North America, and then same thing for multi-featured, 2 years. So you're actually 385, 364, 37. So if we look at C, D, and J for multi-featured, 6 months, 2 years, and 6 months. So you look pretty good there right now. Your discount is like stronger, so you should actually be pulling some market share away from the others in multi-featured. Without spending too much time on this, I suggest you look at each market individually and see how do you compare with the other teams in terms of number of promotions and warranty period, and see if you can change to be more in line with the other teams that have a low price. Okay, does that make sense? Yes. So if let me see how much I can do to that right now, and we'll save whatever I changed, and then you guys can keep improving on it later. Make sense? So if we move up to 2 years here instead of 6 months, your demand has gone way up. Multi-feature is going to be the same because we haven't actually made any changes there yet. This is all the same for your compensation, but you're going to need to hire more workers now because you're producing more cameras. So that's going to be 17. That's still 1. This is going to be 83, and that's going to be 67, 77. It's actually, we'll just subtract 83 again here to make it simple. And then 53, 54, 108, 55. We'll leave that the way it is for now. And we'll leave you're doing okay on finance and cash flow. We might actually be able to increase dividends now a bit, so that should also help for your return on equity. 1.5 and 0.2. Yeah, 0.15. 1.4. There we go. Now you're still an A credit rating, but you've pumped up your ROE a bit. Now, like you may, like it looks like everybody else, for example, is doing 1 week or 1 promotion. So your discount percentages are already like at least at where everybody else is or deeper. So maybe try 2 weeks instead of 1. That's moved up demand even more. That's probably also going to mean that you need to hire even more people. And then change all these numbers. So we're going up and up and up here. So I would suggest tweaking with the promotions as well and your warranty, in addition to those pricing changes. And on it, like I said, your pricing may still be a little bit high based on how low some of the other teams are. So you may also want to try bringing everything down about $5 and see, because you're still way above your $97 cost of production. Maybe bring this down to 158, 159, and 161. There, that brought us up to significantly above ROE for investor expectations. We're just a little bit below the expectations for earnings per share now, so like looking a lot better. I would continue playing with bringing the prices down a little bit and moving the promotions up and see if you can get any better and see what happens there. I'm going to save this so that like we don't have to reinvent the wheel, and you guys continue playing with it, okay? Make sense? Okay. Logging out. That's my 2 cents worth on Globus today. Everybody else, I think you're doing great, but I'm happy to answer questions if individual teams have questions and you want to ask me after class or in my office hours, okay? Any other questions about Globus? Okay, let me go into the lecture, and then we'll be done. Actually, why don't I start, rather than me talking first, why don't we have a quick interlude here with the video that I had for today, which for those of you who are not accounting people, is just a bit of an overview of the 4 basic financial statements that all of accounting and all of finance are based on. It's about a 6-minute video, so let me play that and then I'll go through my lecture.
Want to build and analyze financial models, even if you...
And of course, like was the case last time, I'm
have no
having volume
experience,
problems.
and you've come to the right place. My name is JD, and I have a killer online tutorial for you to learn
Is that okay
financial
for volume?
statement modeling in Excel.
Hi, David Upper, Bionic Turtle, kicking off a series devoted to the Chartered Financial Analyst, or CFA exam, starting with an overview of the 4 basic financial statements. Here on the left, the most popular, probably, is the income statement, also called the profit and loss statement. And this example is for the fiscal year 2011. So this is a flow statement, meaning it characterizes a period of time, typically a quarter, or in this case, a 1-year period. And the important thing is that it recognizes transactions under an accrual, not a cash basis. So it's a period of time, 1 year. The top line here is revenue, also called sales. And so these are going to get in per revenue recognition, not necessarily cash. Subtract the cost of goods sold, in this case 60, gives us the gross income, also called gross profit, of 40. And then other income or expense, in this case I've got $20 in expenses. Deducted gives us the pre-tax income. We can also call that earnings before taxes. I've assumed 40% tax on those. And so if we deduct the taxes from pre-tax income, we get the net income, which is also called the bottom line. On the face of the income statement, there will also be a couple of flavors of earnings per share. Here I've got basic earnings per share, so that's going to be net income divided by weighted average common shares outstanding. So the income statement again is accrual or recognition, not cash basis. And the very stylized form here is the intuitive revenue, recognized revenue minus recognized expenses equals booked net income. So notice the net income under the accrual here is $12, and I've carried that over to indicate that it would increase or plus up the retained earnings, which is an equity account. So the balance sheet here, unlike the flow income statement, is a stock statement, meaning point in time. So there's a balance sheet at the beginning of 2011, and there's a balance sheet that characterizes the exact point in time at the end of the year. And the basic equality on the left-hand side, assets need to equal the sum of liabilities and equity. Assets here, we could have cash, or in this case, I've assumed that we sold $100 worth of product, issued the invoice to our customer, but they haven't paid us by the end of the year, so it's an account receivable asset that hasn't converted into cash. So this is the accrual concept in action. We're crediting the asset because we expect it to convert into cash shortly. So that $100 in this case might equal 88 in liabilities. These could be payables to our vendors, plus the $12 in net income that increases retained earnings. So this very stylized format here, assets equal liabilities plus equity. So then if we go just to the final two quickly, the third and least popular probably is the statement of owner's equity. statement of changes in owner's equity, this also is a flow measure, so this would be characterizing how the retained earnings changed from the beginning of the year to the end of the year. So I just made this up. At the start of the year, assume it was $200. And so this is the shareholder's book equity, or we can also call it net asset, because it's assets minus liabilities is the equity that's left over. At the beginning of the year, there might have been 200. Then we're going to plus or add any net income that was accrued under the income statement. After all, that's going to flow to the owners. So in this case, it's a +2. If dividends were paid out, those would get subtracted. And then also notice we would have unrealized gains or losses. Remember I said that a key feature of the income statement is it's recognized transactions. Now there may be unrecognized or unrealized gains or losses that do not appear on the income statement. For example, a gain or loss on securities that are held available for sale, or derivatives. So they don't show up in the income statement, they don't show up, and they won't convert necessarily into the net income. So those unrealized gains or losses would be captured here after all they haven't been realized as transactions, and they would influence the change in the retained earnings account, so that we compute to see why the retained earnings is what it is at the end of the year. But again, it's going to be what we could say is a book equity or net assets. Finally, the statement of cash flow, because all of the other three are under the accrual principle, the statement of cash flow is important to us because it describes the actual flow during the year of cash. So here, again, like the income statement, it would be over a period of year, in this case fiscal year 2011. It shows us the starting cash and cash equivalents at the beginning of the year, and then parses that into three basic components: cash from operations, cash from investing, and cash from financing, or cash flow from financing. Those three together capture net cash flow during the year, which is going to serve to be the change or delta from the beginning. So the beginning plus or minus the net cash flow gives us the firm's cash and equivalent at the end of the year. So increasingly this statement is important in conjunction with the income statement, which is accrual based. This is David Harper, the Bionic Turtle. Thanks for your time.
So just a little bit of information from somebody besides me about the four major financial statements that pretty much all of accounting and finance are based on. That's a slightly different style than I usually go by. I usually start all of my calculations with the cash flow statement and build the income statement off of the cash flow statement. But basically, it's the same point. The cash flow statement, anytime you pay money out to somebody, anytime you collect money from somebody, it's just like the ledger in your checking account. Like money coming in, money going out, it looks just like your monthly bank statement where you can see every single transaction. That's the cash flow statement. Your income statement summarizes all that into categories and says this is how much we earned from selling this kind of product, and this is how much came in from this kind of product. This is how much we had in operating expenses. This is how much we had in cost of goods sold. This is how much we had in marketing expenses. At the bottom, this is how much the profit was. And then that profit, like he said, goes into the balance sheet, adding whatever, or if you lost money, subtracting what your balance was at the beginning of the year from what it was at the end of the year. And then assuming that you've made money, or if you lost money, that also impacts the how much the owners of the company actually own. And those are the four statements. We're only really going to use two of those in what you need to do in this class: the income statement and the balance sheet. So let me pull up the lecture slides for today. Okay, so this is not in your textbook anywhere. So actually, as far as your quizzes are concerned, as of last week, I had already done the lectures on everything that the quizzes are on. This is really important stuff, though, and it's not otherwise covered in the textbook. So I've put together my own little lecture on it for you, and there's one tool in your case analysis that has to do with this. So first of all, before going into how to calculate everything, I wanted to say a little bit in sort of like simple, plain English as to why these various types of financial ratios are important. So you're going to be calculating different ratios about the two companies you're analyzing, and those ratios are just comparing, how much does your cost of goods sold compare as a percentage of your total sales, or how much money do you owe versus how much money do other people owe you, how much debt do you have versus how much long-term equity do you have, things like this. So profitability measures are basically important because it helps you understand the company's business model. I spent a lot of time doing markups on almost everyone's case analyses to be pretty meticulous about exactly what the revenues were and what the timing was for how they came in, and then what the variable and what the fixed costs were for each of your different industries. Obviously, this is important to understand, whether you make money and how much money you made, but, some companies have a lot of variable costs and not very much fixed costs. Others have huge amount of fixed costs and very little variable costs, and that tells you a lot about the kinds of resources that you need, the kinds of people and qualifications you need to be successful in that business, and the basic types of business activities you need to be involved in. So in addition to telling you whether the company is making money or not, these ratios tell you a lot about the kind of company they are and what it takes for that company to be successful in terms of resources, costs, and revenues. Liquidity measures basically tells you how well a company is able to pay its bills. Most of what we calculate is how much people owe you divided by how much you owe other people, and or stated differently, how much people owe you plus how much cash you have sitting around compared to how much you owe. You want that number to be higher than 1. If the number is lower than 1, it means that if everybody you owe money to at the same time wanted you to pay them, you don't have enough cash to pay them. So in general, the higher this number is, the healthier you are in terms of your ability to pay your bills. If it gets too high, however, it basically means it's a problem similar to some of you have had in Globus, which is that your credit rating is not as good as it could be, or your earnings per share are not as good as they could be because you have too much cash sitting around. You could use it to buy back shares, or you could use it to pay out dividends. You could use it to invest more aggressively in the company. So if you have too much cash sitting around, it's kind of a bad thing because it says basically that you don't have anything better. Like you don't have anything better to do with the money for the company than just let it sit there. So you don't want this to be too high. You want to invest it, but you don't want to be too low either. And then leverage measures basically tell you something about the hard value of a company. There's like, if we go back like almost 15 years now to the whole Enron debacle, like one of the things that was so bad about that is that like most of the assets that like Enron listed were like basically receivables and hypotheticals that they're not actually hard assets. There's some companies that have a tremendous amount of debt compared to how much actual assets they have. So they still have the ability to, like a company like Enron has the ability to spend a lot of money because they have access to a lot of money. But if like everything breaks down tomorrow, they have very little actual cash in the bank or hard, concrete physical assets that you could liquidate and turn into cash. But they have a tremendous amount of debt. So although the company can act very big, like the core value is actually very small. And there's other companies that actually have a very large core value compared to their debt. But that's not necessarily always a good thing, because if you borrow more debt, you actually can spend more money as well. So you want to kind of have a healthy ratio between the core cash and hard physical assets you have versus the amount of debt you have. If you have too much debt, you're kind of in danger of collapsing and not being able to support your debt burden. If you have too little debt, it means you're not really like growing as aggressively as you could. So that's why this leverage measure is important. And then finally, activity measures tell you about how cash and products flow in and out of the company. So what I'll have most of you calculate in this class for that is actually it's average. Like, I can't remember the name of the ratio. It's basically the average amount of time you wait to collect your receivables. And one of the reasons I had everybody list in the business model under revenues, like, do you collect revenues like every time you sell a product, like it is in a company like Target or Walmart, or do you actually like collect a down payment up front plus a huge payment at the tail end of the project, like you would in an advertising agency or potentially a law firm or an accounting firm? So, like, that makes a huge difference on how long you have to wait to get paid, which is, as long as you have access to cash, that's fine. But if you have to wait a long time to get paid, you better have cheap access to cash, or you're going to end up like, even though your profit might be 20%, if you're paying 10% interest on the cash that you're using between the time that you bill somebody and the time you get paid, you're actually not making 20% profit. You're only making 10% profit, because you have to pay to use that cash. You have to wait a long time to get paid. So that's why these ratios are important. For those of you who are accountants, you know a lot of this already. For those of you who aren't, I wanted to kind of put in perspective why it's important to calculate these numbers. Now, the rest of today, the only thing I need to do is actually show you how to calculate the numbers. So most of the rest of this, there's only 4 slides in this PowerPoint. Most of the rest of this is actually kind of hands-on and me showing you what to do. But for your reference, in case you can't remember or don't go back and forth in the podcast, there's a document that I put in Blackboard called Guide to Case Analysis. That's where you find all of the equations for how to calculate these ratios. And then I've listed the resources that you need to be able to find the numbers you need. Edgar is great. It's harder to navigate than Morningstar. Edgar is basically the database where the Securities and Exchange Commission lists all financial statements by public companies. So any company that has stock that you can buy has to do all these reports to the government. And the government puts all those reports on this website free for anybody to look at. But they're not very user-friendly. So they're 300-page documents where the type is fairly small, and you can get all the information you want, but it's a little bit hard to navigate. Morningstar is a lot easier to navigate. It summarizes all the financial statement information for you. But again, this is only for public companies. If you're talking about private companies, you're going to have to go to Mergent Online, find that company's total revenues, and then calculate backwards to figure out what their actual financial numbers are rather than the ratios. You're going to have to use the industry average ratio to calculate backwards, because otherwise there's just no... Private companies aren't required to report anything, so it's hard to find their actual ratios, but we can use the industry average ratio to calculate backwards and find out what their how much money they probably are owed by people in accounts receivable, or how much debt they probably have. And then finally, to find the industry averages, you're going to use... I've scanned as many of these as I could and posted them on Blackboard, but this is like a 3,000-page document. I only scanned the ones that students in past classes have used frequently. So if you can't find the report page that you need, go to the library, the actual, like, for once you have to go to the physical library rather than using like databases. This is the call number. If you're going into the library like this, you know, the checkout counter is over there. There on the same level as the checkout counter are reference books, and it's on that same level over in those stacks of documents. It's a huge book that says RMA Annual Statement Studies, and it has industry average financial numbers for every single industry in the entire world. So if you can't find it from what I've scanned online, just go to the library, find that document, make a photocopy of the one page that you need. Okay? Make sense? Any questions before I go into like the illustration? Okay, that's it from the PowerPoint. So let me pull up the case analysis template again and put that like that, and we'll go all the way down to the bottom. This is what you need to fill out this weekend. So basically, we're going to have the two company names here. We're going to put a bunch of numbers in here and make calculations, and then we're going to put in numbers for the industry. I've got two examples of this, one for private companies and one for public companies. And what time? 1:57. So hopefully I can get this done in less than half an hour. We'll see. So the first example I was going to use is public companies, and I don't think I've actually done a banking example in class yet, so that's the one I was going to use today, is the banking industry. We're going to compare JP Morgan Chase to Wells Fargo. I think that was yours, wasn't it, Jeff? Okay, so Jeff benefits a little bit extra by watching this right now. Everybody else, you're going to do the exact same thing. You're just going to search for the name of your company rather than these two, okay? So first thing we need to do is calculate a profitability measure for JP Morgan Chase, and then the same thing for Wells Fargo. Profitability, if we go to the guide to case analysis and go down to, I think it was page 4 I said? Yeah, so starting on page 4, there's a table here, profitability ratios. I suggest that everyone in here either calculate gross profit margin or operating profit margin. One of those two numbers. So let's see if we can calculate gross profit. Sometimes banks don't list the cost of goods sold in their financial statement. So if you can't find that, because banks basically don't, I mean, they have a cost of goods sold. It's the actual interest that they pay on the capital compared to what they charge on the capital. But sometimes, because it's not a physical thing, they don't report it in the same way. So let's see if we can find that number. If we can't, then we'll do operating profit margin. Okay, so first of all, in order to calculate that, we now need to go to the library databases. And this time, instead of those search databases that we used, we're going to use Morningstar. So go down to the letter M, Morningstar, and then we'll type in JP Morgan there, JP Morgan Chase. Got it? And then more information than you ever wanted to know. All you need here is to click on the Financials tab, and you're going to need income statement, which is already the default that comes up, and then you're going to need some numbers from the balance sheet, and when you need those, you just click here on balance sheet. Okay? So let's go back first to the income statement. We've got a whole bunch of different types of revenues, and then we've got interest expense here, and non-interest revenue, non-interest expenses. So in this case, you don't have an actual line here that says cost of goods sold. sometimes the financial statement will actually say cost of goods sold or cost of production or something like that. If not, think about what it is that the company is that you're studying. So, like I said before, the cost of goods sold in a bank is basically the interest they pay on money versus the interest that they charge people. So we've actually got that here. It just doesn't say cost of goods sold. So if we write total interest expense, let's use that number for the cost of goods sold. And we're going to want, like, total net revenue is our sales number. Okay, so we're going to take that 102,694 and put it, and I want you guys to actually show your calculations here. So put the 102,694 number. Oh, so first of all, we need to go back and look at what was the formula. So formula is sales minus cost of goods sold divided by sales. So that number that we just put in there is the sales number. Then we need to subtract cost of goods sold, which in the case of a bank is this total interest expense number here, 12,781. And then we need to divide that entire amount by sales again, 102,694. Okay? So we copy all that and open up Excel. Equals. And usually you have to take commas out in Excel. Excel gets confused if you have the commas and extra spaces. So, like, take out the commas and the extra spaces, and then 0.8755. So if we go back to here, equals 0.8755. Okay, and then to make this look pretty, instead of veranda 11 bold, let's make it not bold, Times New Roman 12. In general, the default font that I usually use in here is Times New Roman 12. So, you know, after you're done calculating, make it look pretty. Make sure that the names of the companies are actually in black. You're going to do the same exact thing for Wells Fargo, or anybody else in here. You're going to do the same exact thing for the other company. Got it? Questions about profitability before I move on to the next type of ratio? Okay, so liquidity. Again, the formulas for all the ratios are in that guide to case analysis document. So scroll down. Here's all the liquidity ratios. I want you to calculate current ratio. If you really want to get fancy, you can try another one, but honestly, current ratio is the easiest and most consistent one to calculate, and that's the one that I've given you instructions on how to calculate the industry average for too. So for this one, you need current assets divided by current liabilities. So we're going to go back to that JP Morgan statement. Current assets and current liabilities are actually in the balance sheet, not the income statement, because this is, like, we were talking about flow and stock things. Current assets and current liabilities are at a certain time, how much money do I have sitting around, and how much money do I owe other people? So that's going to be in the balance sheet. So if we go here, total assets, total liabilities. So you've got a whole bunch of things here, again, that you're going to have to interpret a little bit. What is a short-term asset, what's not? Sometimes you're going to have a line that says current assets, but if not, basically cash is a current asset. Deposits with banks are a current asset. Federal funds sold, maybe, maybe not. Securities borrowed, maybe, maybe not, because it may take a little time to liquidate the securities. Trading assets and debt securities are also probably not liquidatable quickly. Loans also you can't collect on like instantly. So your short-term assets are basically going to be cash and deposits. Okay, so that's 27,567. 27,567 plus 21,673. And then we're going to divide that by current liabilities. So now we go back, and current liabilities. Federal funds purchase, trading liabilities. Basically, you're going to want payables and short-term borrowing here. Okay, like anytime it says short-term, that's going to be an account. That's going to be a current liability, and anything that says payable is going to be an account liability. Is going to be a liability. In other companies, you may simply have a line that says current liabilities. Okay, but go ahead. In this case, you're going to go in and take 170,330. Plus 35,363. And then again, you're going to calculate what that number is, okay? I'm not going to like go through it right now, but calculate that number. You can see here, you can see here actually that J.P. Morgan Chase owes a lot more than it has on hand right now. So if you notice that Wells Fargo or the industry is really different, you might want to go back and add and think again. Oh, well, maybe we should include federal funds sold and purchased in both, because those are basically like short-term. Those are short-term like bonds, basically. That's what you got there. Maybe trading assets and trading liabilities. Like maybe that's actually the money they keep on hand to be able to like trade back and forth. Make your best judgment call here. And if it looks, after you've done that for both companies in the industry, if something looks weird, go back and think about whether you included the right numbers. Make sense? And then that's basically what you need to do for liquidity. Make sense so far for everybody? Okay. Third, leverage. So if we go back to the ratios again here, leverage ratios. I actually want you to calculate the long-term debt to equity ratio, I believe. Let me check and make sure that's the one I wanted. Yeah, long-term debt to equity is what I want, okay? So if we go back here, this is the formula, long-term debt divided by total stockholders' equity. Again, these are like stock numbers, like what's the total amount that I owe at, today, and what is the total amount of value or equity that the stockholders have in all the earnings the company's ever made today. So that's, again, going to be in the balance sheet. So we got long-term debt right here, 304,978. Make sure that was the number we wanted. Yep, so we want long-term debt on the top of the equation. And then we're going to divide that by total shareholders' equity. You'll see here total stockholders' equity, 176,106. There you go. Just calculate that number, and again, when you're done, make sure that the font is all consistent, and that's what you need to do. And then you're going to do the same thing for Wells Fargo for all three of those, and then finally, actually, before I forget, other, delete that. No one in here needs to calculate the other ratio. It's interesting. It's superfluous what we need to do. I just want profitability, liquidity, leverage, and activity. So finally, for activity, I want you to calculate. We scroll down for the ratios here for activity. Average collection period. Like some companies, inventory is really important. Some companies, like an accounting firm or a bank, have no inventory. But everybody has accounts receivable. So the easiest number for everybody to calculate is average collection period. So that, we're going to need accounts receivable divided by total sales, and then we're going to divide that number by 365 days. So accounts receivable, if we go back, here it says receivables. So that's the same thing as accounts receivable. Sometimes it's called receivables, sometimes it's called accounts receivables. So take that number, 70,147, copy, put it right there, and the other number we need is total sales. So total sales is not in the balance sheet. This is the one ratio where you're going to take one number from the balance sheet and another number from the income statement. The other ratios, you either get them all from the income statement or all from the balance sheet. But we need the receivables from the balance sheet, and then the income statement, we're going to go back and bring in total net revenue. That's the same thing as sales, 102,694. Copy that. But remember, we have to divide that number by 365. So put that in parentheses. Calculate that number, and you're good. Do the same thing for Wells Fargo, okay? And then the next thing we need to do is the industry average. And once I get done with this, I'll tell you a little bit about the comments, then I'll show what's different about this for private companies, and we'll be done. Okay? Yes,
What year
Maddie.
do you want us to use? Do you want us to use the most recent?
If it's possible. Sometimes if you notice here, like we're missing 2014, so it'd be nice to use 2014, but I can't because we're missing the information here for JP Morgan. And in the balance sheet, you'll notice as well, like if we wanted to include that federal funds purchase number, we don't have it for 2012 and 2013 yet, or 2014. So use the latest year where you actually have all the numbers, okay? And then before I forget, for your footnote, I want to know where you got the information. So this is actually not one we're going to, Jeff, for your example, we use 2010, right? So what I want you to put for the footnote here, put the footnote there because you're getting them all from the same source, and you're going to go in and put Morningstar. Actually, everybody's going to be the same thing there. So just put Morningstar 2010 financial statements. Okay? And then if you ended up using the 2012 numbers for Wells Fargo, just make sure to put Morningstar financial statements 2012. Okay? Make sense? Maddie, does that answer your question? Okay, cool. So then we're going to do the same calculations for Wells Fargo. Now, the industry, you'll notice here, I put a document in Blackboard, instructions for calculating industry average financial ratios. Open that document up, and it looks like this. So the first thing you're going to do is you're going to go to this website, and you're going to find the 6-digit NAICS code for your industry, okay? Then you're going to go find this book. If you happen to be lucky, I've already scanned the number and put it in Globus, and put it in Blackboard. So you'll see here, Industry Average Financials PDF document. Open that up, and you'll see there's 62 pages. So there's 62 different industries that students in the past have used at one time or another. I've scanned them and put them in here. If this is hard to read, if you just increase the size, it usually takes care of the problem with the photocopy, and you can see the numbers that are in the dark, like the black areas too. Okay, so if you're lucky, your statement is going to be in here. So I actually already checked. Your number is consumer lending 522291. So you'll notice here at the top, it's listed by name, but then at the end it's listed by number, and these pages are actually in order of code number, not in order of alphabetical. So if we scroll down to the number 5, let's see, 23, so we're not there yet, keep scrolling. 336, sporting goods, nope, not there yet. 445, still not there. 445, 452, 51, we're getting close. We need 522291. Nope, 512. 522291. Finance consumer lending. Okay? So these are the numbers you're going to want for banking. Same thing for everybody else. If you're doing accounting, go in and look up the code for accounting and then see if it's scanned in here. You can do the same thing for any other industry. Delivery services, retail, wholesale, petroleum, anything. You can find the code and then find it in this document. If you can't find it in the document, then you need to go to the library and make a copy of this page for your industry. Okay, so now back to the instructions. On the page you photocopied, do the following to calculate each of the ratios for your industry. So instead of using Jeff's in this case, I've put together an example that is, I put together an example that's going to be like standard and easier to read for everyone. So if you look, the model, the pages have the exact same format. Every single page has the same numbers in the same places. So first of all, gross profit margin. So you're going to go to the column in the middle of the page and find the line that says gross profit. So the document that I used as an example is industry average financials by sales example. So if you look at this and we expand it, I said go down the column, find the line that says gross profit. So go back here. Gross profit. It's under income data. 62.9. So 62.9 in the example. That's your gross profit margin. So all you need to do, so this would be a different number for banking, but based on the example here, we just go in and put 62.9%. And before we forget, the footnote is going to be RMA Annual Statement Studies guide makes code 522291. That's it. That's all you have to put. RMA Annual Statement Study Guide and whatever the code number was for your industry that you used. Okay? So, coming back up here, that's how we calculate the first number. The liquidity number, go back to the instructions. Current ratio. Go down the column in the middle of the page, find the line that says current. See here, ratios, current, 1.2. 1.2 is the number you want. So that is going to go right here. That is not a percentage, by the way. Current ratio is a fraction, so it's going to be 1.2 or 1.5 or 2.0, or it's going to be 0.75, depending on whether the numerator or the denominator is larger. It's not a percentage. This is a percentage. Okay? Put that number in there. We're halfway done. Leverage. Long-term debt to equity ratio. Go down to the column, find the line that says long-term debt. So, in the example, it's under liabilities, long-term debt right there, 27.4. Now, again, these are examples from the like restaurant industry. It'll be in the same place on your report, Jeff. It'll be the same place in everybody else's report. It'll just be a different number because you're looking at a different code. Okay? So in this case, long-term debt, 27.4. What does it say to do with that number? So we're going to calculate this number. So first, we're going to take long-term debt and we're going to go into no, that's not what we wanted. What did we say the number was again? 62.4? No, 27.4. But we need to divide that by another number to come up with what we need. So go down the column to where it says gross profit. And that's where we're going to get the net worth number. So in these reports, instead of saying, actually here, it's the gross profit section, but we actually want, I typed that wrong. You're going to want the net worth. I'm going to update this document. This should say, that should say net worth. I'll update the document as soon as we get done. I copied and pasted and copied the wrong number. So you're going to want the net worth number, which is right here, 18.2. So that's going to go equals whatever that number is, okay? And then finally, activity. So activity, average collection period. First of all, here's what we need. So we're actually going to need a number for trade receivables. We're going to need a number for sales divided by total assets. So this is a little bit different. The reason it's different is because the reports from RMA annual statement studies are all reported in percentages. The numbers that you get in an actual financial statement are reported in dollars. Make sense? Like the dollars in a balance sheet are apples. The dollars in an income statement are oranges. You can't compare them directly. That's why we need this sales divided by total assets number. This is like the conversion factor that converts balance sheet numbers into income statement numbers so that you're comparing apples to apples, okay? So you're going to need to go find these two numbers and then solve this equation. So trade receivables, 1.1. So go in here, 1.1, and that's going to be multiplied by sales. That's sales divided by total assets number. So that sales divided by total assets number is, you got to scroll way down to the bottom of the page. Sales divided by total assets. You see that here? You're going to want in all of these where you have three different numbers there, I want you to take the one in the darkened area directly across from the words. Okay, so 3.1 is the number we need there. So times 3.1, and then all of that is going to be divided by 100 in this case. So 100% is like, because these are in percentages instead of dollars, your like total sales is 100%, and it's divided by the number of days in a year. So divide by that. Equals, and as you can see here, that's going to end up being 12.45. Last thing you need to do, actually make sure that all of the font is like consistent. So that's good. Eventually that'll be a number. And then you're going to have numbers for Wells Fargo here too. So let's say, just putting numbers in, this is going to be something like 0.80, and you're going to have a calculation there, but let's just assume that the number was 0.80. This, in ballpark terms, like 50,000, or yeah, 50,000 divided by 200,000 is about like 0.25. And let's say this is 0.5. And then this is going to be, so 304 divided by 176 is a little less than 2. So call it maybe like 1 point, I don't know. Like, we could calculate the actual number, but just to show you guys what I want here, let's say this one's 1.8, and 27.4 divided by 18 is about 1.3, I think. And then this 70,000 divided by, so 102 divided by 365 is about what, 30, about 3,000. Is that right? I don't know. So 73,000, about, call it 25 days, and let's say this is 20. So that way, now we've got numbers for everything. I made them up, but I want you guys to actually calculate them correctly. Here, down at the bottom, you're just going to put bullet points: profitability, liquidity, leverage, and activity. And I want you to compare the two companies to each other and to the industry average. So JP Morgan and Wells Fargo both have healthy profit margins, significantly above the industry average, period. Okay, so compare the two companies to each other. Okay, JP Morgan's is a little bit better, but they're both basically 0.8. There's not a big difference, so we'll say both of them have healthy profit margins, and it's a lot higher than the industry. For liquidity, again, first of all, I'd go back and recalculate, make sure you've got the right numbers, but assuming these were the numbers, we'll say JP Morgan and Wells Fargo both have dangerously low liquidity, low current ratios, well below the industry average, period. JP Morgan's ratio is twice as bad as Wells Fargo's. They are in extremely high level of debt. Okay, like that would be your two sentences. And then leverage. Both of the companies seem to have a relatively high amount, a little bit higher debt than the industry, like 1.9 and 1.8 compared to 1.3, and then both of them seem to have collection periods that are slightly longer than the industry average, but they're comparable to each other. Period. So 4 bullet points, 1 for each area, and then just to make it easy to read after you get done writing your comments, underline those so that the title sticks out from your comments, and you're done. Does that make sense to everybody? Okay, let me do an abbreviated version of the next one. I'm just going to show you what's different. Okay, so in this case, I'm going to use accounting as an example because almost every accounting firm in the world is private. It's a partnership. It's privately owned. It's not a public company, so you can't find their financials in Morningstar. So you're going to have to do something totally different. In this case, I'm going to compare KPMG and RSM McGladrey, the two companies that were in Dahi's case. And then the industry. So first of all, industry, we can go ahead and edit here. That's going to be practically the same. It's just that we want the code for CPA firms, which I already looked for before. It's 541211. But if you didn't know that number, you would go to the website naics.com and find your NAICS code and just type in accounting. You'll see here, Offices of Certified Public Accountants, 541211. 541211, okay? So we'll go back and change those numbers later, but I'm not going to worry about changing them now because the way that you calculate them is exactly the same. Actually, I am going to do it because I need those numbers to show you what I'm doing with the other things. So let's clear all of these because we're going to need to fill them out differently. Copy, paste, and do the same thing here. Okay, so for the industry, if we go into, so we said we wanted 541211. So scrolling down, yep, there we go. 541211. So we're going to do the same thing to calculate industry averages. Make that a little bit bigger so we can read it. So first of all, we needed gross profit. But here, because there's not a lot of like cost of goods sold, I mean it's the billable hours of the attorneys, but because it's not a physical, tangible thing, a lot of accounting firms don't list the number there. So we're actually going to calculate operating expenses, or actually we're going to calculate operating profit margin instead of the gross profit margin. So you'll notice in the description here, operating profit margin is sales minus operating expenses over sales, or operating income over sales. So we want to go back here and first of all that operating profit is the number we want for the industry. So the industry is 17.3. And here's where it gets different. So if I open up the document in Blackboard that says instructions for calculating private company financial information, open that. So since it's difficult to find financial information for private companies, you have to work backwards based on the industry averages. So again, the first thing you're going to do here is go to Mergent Online, okay? So going to the databases again. Same database we used for doing business-to-business market sizing. We're going to use that for the financials here as well. But instead of what we did for market sizing, we just need the number for annual revenues for the two companies that we're looking at. So again, make sure to click D&B Private Company Database here. In company search, we're just going to type in KPMG. And that says 2 billion, basically, 2.4 billion in annual revenues, okay? So even though they're private, you can find the revenues for almost any private company just by looking in Mergent Online. So if you look back at the instructions here, so find the figure for annual revenues. Eventually, that's going to get plugged in. We're calculating operating expenses, so sales is the number that that we use here. So that sales number is, what did we say? 2.4 billion. So we go in here, 2.4 billion times operating expenses. So if we go back into the industry average financials number here, operating expenses 82.7 and operating profit margin is 17.3. So basically in this case we copied over operating profit margin here. So we want to figure out, we don't know what the exact ratio is because we don't know what KPMG's operating expenses are, but we can estimate based on their revenues and the industry average what their actual amount of operating profit would be by multiplying 17.3% by 24 or 2.4 billion, okay? So 2.4 billion, those 2,400 to put that in millions times 0.174 for 17.4%, 417.6 million. So if we go back in here, dollars for 17.6 million. Or if we want to make all the numbers the same, that's actually 2,400 million is the same as 2.4 billion. So that way all of our numbers are in millions. So you're not actually calculating the ratio for KPMG. You're using what their annual revenues are to calculate what the actual amount of operating profit is. Does that make sense? And it's the same thing for anybody that has a private company. You can go find that company's annual revenues number and then use the instructions that I included in Blackboard, instructions for calculating private company financial information. Just follow these instructions and it'll tell you what numbers you need, okay? All you need is that industry average document from the RMA Statement Studies Guide and the total annual revenues of the company. Everything else, you can use these instructions to calculate. Does that make sense to everyone? Okay, that's all I had for today. If anybody else has questions, come up and see me. Otherwise, I will see everybody on Wednesday for the my comments and discussion on the internal analysis tools, and hopefully I'll have more news for you then on who's going to be speaking when as guest speakers.